How can organisations plan more effectively for future disruptions? What does tomorrow's workplace look like? How does sustainability boost business performance? These are just some of the global challenges facing business leaders today that we discuss in The Art of Smart. With analysis and insights that evaluate the quality of smart decision-making against 4 significant factors, we look at some of the movements and trends emerging as imperatives for the majority of organisations, irrespective of location, sector or size. Throughout the year, we will develop the conversation with industry experts and thought leaders and regularly publish content, smart decision-making that delivers lasting value. The Art of Smart. To read more or to join in the conversation, go to crowe.com/Art of Smart.
Hi, warm welcome to another riveting episode of Crowe and MICCI webinar. Today, we have something which is quite good for you guys to be there. But first, let me introduce myself. My name is Sean Chia from the Malaysian International Chamber of Commerce and Industry. We are the oldest chamber in Malaysia, 184 years old, and we have about more than 1,000 active members and a reach of about 25,000. We are a member of the International Chamber of Commerce based in Paris, and one of 5 component members of the National Chamber of Commerce and Industry in Malaysia. Okay, without further ado, today we have a very practical aspects of business valuation. I'm sure there's a lot of business owners now who have nurtured and built their own businesses from scratch. It's their baby. And somewhere along the line, there will be someone asking, hey, do you want to sell? And then you will be wondering, how much do I value it at? Yeah, okay. Before I hand over to our panel speaker, let me just remind you on some of the housekeeping. If you can mute your audio and turn off your camera during the webinar session. This is to avoid technical difficulties during the live streaming. Yeah? Should you have any questions, you can include them in the chat box below if you're on the Zoom, and we will try to answer them as best as we could. Those who are watching us from Facebook Live, please feel free to put in your questions in the comment section, and then we will escalate it to the speakers. Okay, so without further ado, today we have our panel speaker, Ms. Jessica Poon, who is a director in Crowe Malaysia Corporate Advisory Division, has over 15 years of experience. The experience includes corporate advisory, IPO projects, equity valuation, feasibility reviews. She has been involved in various valuation exercises in public listed companies in the areas of oil and gas services, ICT industries, as well as private limited companies. In the area of healthcare, logistics, oil and gas, green technology, and manufacturing industries. That's just only a few to name. There are lots more, I guess. So without further ado, can I introduce you to Ms. Jessica Poon? Are you ready?
Yes, I am, Sean.
Okay, then I'll hand over the floor to you. Jessica.
Thank you, Sean. Thank you, Sean. Hello, everyone. Thank you for joining us today in my session on the practical aspects that one should generally consider when it comes to valuing their business. This covers how much reliance we need to put on factual data as compared to implicit assessment in valuing our business, the type of valuation methods we use, and also what are the areas we should consider when it comes to valuing or evaluating our company. Next, we will also explore with you the areas within your transaction that we can help you with. And last but not least, our question and answer session. So I hope you enjoyed it. Now, one of the most cliche questions that we usually get whenever we value a business is that whether is it an art, as in any method that you employ in your valuation, they may not necessarily be that apparent in your end result. In other words, you are the master of your interpretation. Now, I would say that a valuation is not an art, neither is it an expression of your creativity, but rather it must be backed by data, because at the end of the day, your valuation results, they must make sense and able to stand scrutiny. Also, when it comes to performing a valuation for a particular business, the method that you use to value that business may not be suitable to value another business, which we'll come to later, where I'll explore with you the various factors that we should consider when it comes to determining which method to apply to value which type of business or company. Some would also wonder whether is valuation a plain guesswork, as in so long as the value feels right to you, what your gut is feeling at that moment, or it looks right to you or about there, that value should suffice. Now, I would say that it depends on how much emphasis that we should place on factual data as compared to our judgment call when it comes to our valuation methodology. I would suggest that we place more reliance on factual data, because when it comes to doing a business valuation, there are certain areas within your valuation that you will need to adjust, and most often than not, certain areas you will have factual data to support your adjustment. Let me share with you an example. If you're valuing minority interest or you're buying minority interest in a business that does not give you control over that company, technically, the price that you would pay per share in that minority interest should not be equivalent to what you would usually pay per share if you are buying control in a business. So when it comes to valuing minority interest, what we will do is that we will check what are the value of market transaction value that people are paying for majority interest in the market for similar businesses, and inversely, that premium that they pay to get control should reflect how much you need to consider when it comes to accounting for the lack of control that you get from buying that small block of shares. Also, the data that we select when it comes to comparing it or using them as a benchmark to the target we are valuing, they must be comparable. For instance, if you're valuing a company that is in the food services industry, logically you do not select data that refers to companies that are involved in the manufacturing of food packaging materials, because all in all, they belong to different sector. One is in the services sector and the other, the manufacturing sector. The method that we use also, it must be suitable to the business that we are valuing. If you are valuing a company which has an ongoing operation and you expect that business to continue in perpetuity after you've acquired it, the method that you use to value such a business, it would differ as compared to if you are looking at a company without an operation, but rather invests in a pool of assets, be they properties or even investments in other companies. I would also suggest that we have a lesser reliance on the implicit assessment of our business valuation. Now, when it comes to doing a valuation, certain area can be supported by market data, while certain area will need your judgment call. One of the general example that we can think of is that when you're valuing a business based on their ability to earn future cash flow. So basically you're assessing how much that company is worth today based on their future earnings capability. So you will be assessing that company's cash flow forecast to determine how much worth is that company today. Now, as we all know, there is a risk that any basis and assumption in that particular forecast may not be met when the time comes, whether due to reasons beyond the management control, such as a pandemic as what we are living in today. So when you're assessing any company's forecast, always bear in mind to consider a premium to account for the risk that any basis and assumptions in the forecast will not be met in future, because forecasters are inherently risky. There is no certainty, no warranty that it will be met. So now, the data that we select also for our business valuation, oftentimes you will face the challenge that you do not have a homogeneous pool of data to use as benchmark to value the target business that you are looking at, because either your pool of data or the companies they are benchmarking against are larger as compared to the one that you're valuing, or they are more marketable, especially when you're valuing a private limited company, which is considered less marketable as compared to their public listed peers, and also due to various factors. So in this case itself, you will have to question yourself, how comfortable are you to use this pool of data that you already have on hand and apply them to your valuation, and also what are the other adjustments that you need to make before you conclude your value. As for the guesswork side of it, whether or not does the value feels right to you or looks right to you, how your gut is feeling at that point in time, I would say just put a stop to it, because most often than not, perhaps your gut feel is just due to indigestion at that moment. Now, there are three main methods that we usually employ in a business valuation. One would be the market approach. Now, there are two sides to the market approach. One is on the market side, which is driven more by how the market is performing at that point in time when you are doing your valuation. And the other side of it will be the business you are valuing, or the company you are looking at that point in time. So now when you are using the market approach, what we will rely on is on market multiples that are usually obtained from similar businesses in the market, either from public listed companies where their data are readily available, such as share prices and financial data, as compared to private limited companies, or what are the market multiples that arose from transaction of similar businesses in the market. Now, these multiples will be benchmarked against the other side of the market approach, which is the business side of it or your company side of it. So it could either be benchmarked against your revenue line or your operating profit or profit after tax. So since the market side of it is not within anyone's control because it depends on market movement, on the company end of it, when we apply the market approach, always make sure that your base financial line must be sustainable in a way they must make sense. Always compare it against what are the level of earnings that a company can maintain as a going concern, as compared to looking at only a specific time of the company's performance. Because as we all know, oftentimes certain businesses may be affected by how the market is performing or may be affected by other extraordinary circumstances. Always look from the maintainable earnings perspective. The market approach is more suitable to value companies that are able to demonstrate that they are able to maintain a certain level of earnings historically, because this would also assist them to justify their maintainable earnings moving forward. Another method that we usually use is called the income approach, where we look at a company's future earnings capability. So now in this case itself, you are assessing the company's value based on what they forecast or they expect to earn in future. So in doing our valuation based on the income approach, what we will usually do is that you discount the company's future earnings to estimate what is their worth today based on their future cash flow. And this discount rate is calculated based on market data of companies from similar businesses, most often than not from public listed companies. So it is similar to the market approach, where there are two sides to it. One is on the market side, where you look at data from available listed companies, or even how the geographical location is performing, what is the additional risk that you need to place. And on the other side, it is from the company's perspective, where you look at what the company expects to perform in future. Another valuation approach that we look at over here will be the cost approach, where we estimate how much it costs us to replace or recreate an asset that is comparable to yours. In other words, the cost approach is actually very suitable to value investment holding companies, because the value for such companies, which normally doesn't have an operation on its own, it is determined by the worth of the assets that they own at that point in time when you're doing your valuation. So one of the most generic methods that we apply under the cost approach would be the adjusted net asset approach, where you estimate the fair value of the company's total assets and total liabilities at that point in time and sum them up to arrive at the adjusted net asset value for that company. So the cost approach is actually very suitable to value investment holding companies and also to value startup companies, because certain startup companies may lack historical performance to enable us to directly apply the market approach and also to apply the income approach, because the lack of historical performance may also pose a challenge for them to justify how they expect to fulfill or to achieve what they forecast in future. So for startup companies, usually what we look at is that whether or not does those company has a certain asset that is of value to them, be it proprietary technology, for instance. So in this way, we would apply the replacement cost method with consideration to an element what we call developer's profit before we arrive at the value of that asset. And that asset would somehow be reflective of what is the fair value of that company at that point in time before commercialization, for instance. So now we've looked into what are the types of valuation techniques that we have, and most often than not, which method that we select depends on the position of the company that you're looking at that point in time. Let me share with you an example of what we had encountered previously. We have valued a company in the services sector, which had been in operation for more than 10 years when we were doing our valuation. So as usual, we received a set of financial forecasts from the management, where the management expected the company to be able to grow organically in future. So when we were doing the valuation and after we have evaluated what we had, we noticed two things. One is that over the course of their operation, that company has never generated any operating profit. And the next thing is that the company's operating cash flows were more or less supported by dividend declared by their subsidiary all this while. So in a way, the company's value lies more in this subsidiary or this particular asset that they had invested in as compared to their own operation as a going concern. So we had applied instead the cost approach to value this company as compared to the market approach, because they don't have any operating profit for us to serve as a benchmark. There is no certainty that the company is able to maintain any level of positive earnings moving forward as well. So the cost approach may seem pretty straightforward as compared to the market and income approach, because the main challenge that we usually have is that in terms of getting a pool of homogeneous data that can be an exact comparison to the one you are valuing, because your pool of data may vary in terms of size, marketability, especially when you're valuing a private limited company as compared to the data you are using, which are from public listed peers, and also perhaps the pool of products that you carry as compared to the peers you're comparing yourself against. So when you're applying market data, you would have to consider multiple factors to adjust your market multiple if you're using the market approach, and also the discount rate if you're using the income approach. Now, so in a way, the method that you select for your valuation, it very much depends on the position of the business you're valuing at that point in time, and always consider various areas whether or not any adjustment you made can be supported by factual data. If they can't, you have to make various implicit assessment to arrive at any additional adjustment that you have to apply to your market multiple or discount rate. Now, we've talked on how much reliance we place on market data when it comes to our valuation, because all in all, these data are representative of how a particular business or a particular sector is performing at any given time. So in a way, the timing that we apply to extract that market data, it is also very much influenced by the time itself. So be it if you are using market data based on this current time when we are affected by an extraordinary circumstance, be it a pandemic, or if we are to extract the market data based on the timing in a normal business as usual scenario, not affected by any extraordinary circumstance. So what I'm about to share with you over here is a sample company, Malaysian companies involved in the healthcare supply chain, as well as in food production. Now, I must qualify upfront that this is just a list of samples that we've used over here for purpose of our illustration in my presentation, and also they are not directly representative of how that particular sector is performing at these two given period. So what I have over here with me are price to earnings multiples, meaning how many times the market is paying for the company's profit after tax during the period before the pandemic started up to 31st December 2019, and after the pandemic started up to 31st May 2021. So what we notice over here today is that these companies generally displayed higher price multiples, higher number of times over their profit after tax after the pandemic has started, which is either due to higher share prices or even lower net earnings as displayed by certain food producing companies. So if we are relying on market data for our valuation, always assess your company's size and marketability as compared to your peers, especially when you're valuing a private limited companies, which is deemed less marketable as compared to a public listed company's shares, which are more liquid. Now, always assess your business position also, because whatever position that you have at that point in time, it determines the suitability of the method that you use. And most importantly, use a longer data time frame, because as you can see today, whatever number of times that the market can pay for your PAT today, it may not necessarily represent what you will get in a normal business time that is not affected by any extraordinary circumstance. So in a way, market data only serves as a guideline to you in your valuation and not an exact conclusion to conclude your valuation, because there may be differences in terms of size, market reach, as well as product pool. Now, how do you set your expectation on the value you wish to get for your business when you have no or lack of historical track record? So what I would usually advise or usually suggest to you is that to think from the perspective of whether or not do you have a feasible story to sell. I must say that fairy tales don't sell. Whatever business plan that you are putting forth to your investors, they must be supported by relevant data or even by what you have on hand at that moment. Whether do you have any exclusive contracts on hand that actually sets you apart from your peers within the same sector, or whether or not do you have data specific to you that will be able to support what you say will be your growth trajectory moving forward, so that what you have today or what you have to offer actually matches what is the value you're asking for. But I would also suggest that you do a business health check on your company by asking yourself some simple questions, as in, how have you performed against your competitors? Whether are you performing within those in the same sector, or are you performing in a way that what is expected of someone or of a business in that particular sector? If you have been performing on par with the rest of the peers in the sector, what actually stops you from growing further? Is it due to this pandemic that we are having? Is it due to the lack of capital, or other factors such as succession, for instance? And if you notice that you have not yet been performing below par, find out where are your speed bumps. Internally ask yourself, how have you grown over the years? Whether or not have you been seeing any volatile growth, or have you actually been seeing any growth over the years? And if you have not, what actually caused it? Was it because you don't have a robust enough business plan to run it, or your previous business plan was actually lacking in certain areas? And if you have been growing organically over the years, what is your plan moving forward? So we have been touching on what is your business plan, what do you have to support your plan, and vice versa. So that proves that most importantly, you have to ask yourself whether are your plans realistic. I would also suggest that you do a financial health check on your company by asking yourself some simple questions. Check on your cost structure, because as we know, cost affects profit. So check whether do you have any extraordinary costs that you have been assuming in your business that is not necessarily incurred in a business such as yours, and what is your plan? What do you intend to do about it? And do you wish to hive it off, and how do you manage? How do you think of managing it? Check also whether is your cash flow aligned to how your business is performing, because as we know, if a business has any operating cash shortfall, conventionally, it will be substantiated or supported by external borrowings, and we all know borrowings reduce the value of a company's shares. So in a way, when you're assessing the going concern of your company, always start with what you know and what you have in hand, which is how you wish your company to perform, what is the profit margin that you wish to achieve for your company. Because the external factor, as in how the market is performing now, how the market is expected to perform in future, that is not within our control. If you can start with what's within your control, you manage what's within your control, half of your battle would have been won. So now we've touched on how much reliance that we need to place on factual data as compared to implicit assessment, which is not supported by any data whatsoever. It's more of your judgment call. We've also touched on what are the types of valuation methods that we usually use in our valuation. And also we touch on what are the areas you should think of when you are evaluating your company from the financial and business perspective. So how do they all fit in? Now, if you are using a market approach where you apply a market multiple to your earnings, your consideration would affect how much additional discount that you need to place on your market multiples, be it from the marketability side, the control side, or even to account for any additional risk that you can see. If you are using the income approach where you discount your future cash flow to estimate what your company is worth right now, today, your consideration would affect how much additional premium that you need to add to the discount rate on top of the discount to account for the lack of liquidity of a private limited company. So this additional premium, it could be due to you after your assessment on the company's forecast to account for the inherent risk. If you are using the cost approach where you evaluate a net asset of a company, or if you are trying to estimate how much it costs to recreate an asset that is similar to the one you're valuing, this would affect your judgment. What is the cost to replace or recreate your asset, whether or not it's a cost that you apply within industry norm, or if you are looking at a set of costs that the company or even the creator of the asset had provided to you, whether are there any elements within that cost that may not necessarily need to be imputed if you are creating a similar asset. This would also affect how much profit element you need to place on top of the cost to recreate that asset. If you are looking at the company's books to determine its value, whether or not the fair valuation method that you apply to value that company's assets and liabilities, are they within industry norm or based on applicable standards of valuation. I'm going to share with you now one of the case studies that we do regarding AirAsia's acquisition of Gojek's business in Thailand. Now, as we all are aware, in July this year, AirAsia had announced that they are acquiring Gojek's business in Thailand for $50 million, which will be paid via issuing 4.76% shares in AirAsia Super App. So what this implicitly shows is that it values AirAsia Super App at about $1 billion implicitly, which is of course higher as compared to AirAsia's value of about $820 million at the time when they made this announcement. So indirectly, the value of $50 million proposed for Gojek's business in Thailand, it actually came up to about 6 times of Gojek Thailand's last reported revenue in 2020. So in a way, the business value multiple of approximately 6 times achieved by Gojek Thailand from this acquisition, it is actually higher as compared to AirAsia's business value multiple, which only came up to about 4.6 times of its revenue, last reported revenue in 2020. So what actually makes Gojek Thailand so attractive that it can actually command a higher value as compared to its acquirer, which we all know is a public listed company and is more sizable as compared to Gojek's business in Thailand? A bit of a history on Gojek Thailand's business. It began under the ride-hailing app Ojek in Indonesia in 2010 before they expanded overseas in 2018 and began under GAT in Thailand in 2019. So when this announcement was made, we found that Gojek Thailand connects more than 50,000 drivers and 33,000 merchants across its apps, which are mainly its ride-hailing, food delivery, parcel delivery, and e-wallet app. And I must say that Gojek Thailand has no profit track record. They have never achieved any operating profit since they commenced operation in 2019. So what actually drives its value? What we can notice is that internally, there is already an existing infrastructure. Any acquirer need not spend additional time and money to recreate this infrastructure to reach the level of what Gojek Thailand already has at that point in time. Also, it would have established its presence in Thailand based on its pools of drivers, merchants, and app users. What we notice also is that the external value drivers would have played a role to drive Gojek Thailand's value, because in May 2019, DBS Singapore had estimated that the Gojek app was used for about 1.2 billion times in Southeast Asia alone, which is pretty remarkable compared to Uber's and Lyft's app, which was only used for about 6 billion plus times worldwide. Also, any acquirer will be able to leverage on the high number of ride-hailing users, which will lead to other services and payments that can be monetized. So it is not as much as the 50,000 drivers and more than 30,000 merchants and existing app users for you today. It is more as in what can you tap from this existing data pool you have on hand for future earnings opportunity. Also, we noticed that the Southeast Asia's online food delivery and ride-hailing market is expected to grow at 30% on average annually up to year 2025. So now we are sharing with you what is our take on the valuation of Gojek Thailand. How would that business be valued? Now, I must qualify also, we are not privy to how that 50 million value comes about. We have no information whatsoever as to how that value was concluded. So our take over here on this valuation is merely based on what we know based on available market data, which is basically the expected growth rate of the industry at 30% per year up to 2025, and also AirAsia's business value multiple, which is about 4.6 times of its revenue. So using all this data, what we can get from the web, what we did was that we did our assessment on how Gojek Thailand's business value would be. So what we have is that if you look at a 1 year forward basis, which is 1 year after this year where the announcement was made, we estimated a business value of about $54.8 million for Gojek's business in Thailand, which is pretty close to the $50 million offered for Gojek Thailand by AirAsia, which may have been adjusted to take into account synergistic benefits, for instance, or other factors which we are not aware of. So what we can conclude here is that Gojek Thailand's value was derived possibly based on its expected future performance using the income approach, because there is no historical profit which will enable us to directly apply the market approach to get its value. And also it would have considered Gojek Thailand's future potential either based on what it already has internally or the external sector's growth driver. And Gojek Thailand's business value would have also considered any synergistic benefits, because as you can see from here, if all these growth parameter holds 5 years down the road, what we can expect is that perhaps that business value would double come 2025. So let's see what happens after 5 years. So as my parting note over here to you is that when it comes to valuing a business, there is no one size that fits all, because not any two businesses are alike. You may differ in terms of size. You may differ in terms of the type of business that you're valuing. So a method that you use to value one business may not be suitable to value another business, as I pointed out earlier. Also, if you are assessing your own business value, I would suggest that we have to be practical, because your emotion has no place to justify your value, but rather the value you're putting forth, it must be driven by data, because you have the relevant information to support your value that will be strong enough for you to put it through. Also, at the end of the day, the value that you propose forward, they must make sense. I'd always say that if you propose a value that does not make sense, it is as good as you not proposing a value at all. So how can we help you in terms of business and equity valuation when it comes to certain areas or certain stage of your transaction? Well, you will need to consider a business or equity valuation, especially when you've decided to divest either all or certain parts of your business, or if you have identified a target that you wish to acquire, either in terms of expanding your existing business or to expand the service or the product line that you're offering. Also, after you've signed the heads of agreement or conditional SPA, where there may be an option for the buyer to revise the offer that they put forth earlier. So in that sense itself, you may need to evaluate, especially when you had more information on the target after signing this agreement, for you to consider whether or not do you need to adjust the offer that you put forth earlier. Now, when you have concluded the acquisition, where you have actually gotten control in the company, you may need to value the target or the company that you have acquired, their tangible assets and liabilities at the point in time you have get control for purpose of fulfilling your financial reporting standard. So in terms of the purchase price allocation exercise, this merely requires you to allocate the price that you've paid for that control in that particular target across that target's tangible assets and liabilities, and also whether does that target has any intangible asset at that point in time that can be valued separately and where it fulfills the valuation or the financial reporting standard requirement to be valued separately, such as brand name, customer relationship, or even proprietary technology. And any excess or any part of the assets in the target that you cannot allocate the purchase price, it will end up as a goodwill in your company's books. Now, on the next stage, when you're thinking of divesting or seeking additional investments, you will want to consider how much to put forth, because most importantly, for the sellers itself, it will be whether or not are they accepting a good offer, and for the buyers, of course, whether or not are they actually overstating their offer. I think that's most important in anyone's consideration. So other than business and equity valuation, what we can offer you also is to help you to do the financial health check on a company that you're looking at to acquire. This is covered under a transactional due diligence review. We can also assist you to do the business health check for the company, especially when it comes to evaluating that company's business plan, to make sure whether or not does the basis and assumptions they put forth, the storyline they sell, does it actually make sense. We also provide government advisory services where we looked at government projects handled by certain government agencies. Under our merger and acquisition side of the service, we provide strategic advisory services either from the buy side or the sell side basis, and we also can help you to manage your transaction from start to finish. We do provide insolvency services also, which is the other side of our service, whether in terms of acting as your liquidator or receiver based on the power of court or the financial institution's debenture. And also, we do provide restructuring services, be your debt restructuring or scheme of arrangement pursuant to the Malaysian Companies Act, and also act as monitoring accountant for certain establishments. I will now answer certain questions that are posed to us when some of you registered for this session. Now, the first question that I have is that how do we actually value tech companies? Now, I will limit my answer to refer to tech companies which are startup and also tech companies that are already in operation for a certain period of time. Now, for startup tech companies, as I relayed earlier, it would lie more on the asset that they own at that point in time, because most often than not, this company would have owned certain proprietary asset. So I would say one of the recommended method would be the cost approach, to estimate how much it costs us to recreate that particular asset with an element of profit involved. Now, should the tech company has been in operation for a certain period of time and also has certain order book or certain data to suggest or to even support its growth trajectory or growth trend moving forward, I would propose that we approach this valuation using the income approach, particularly the discounted cash flow method. One of you also asked that how do we value professional services firm, as in like a firm like Crowe Malaysia, for instance, or any other professional services firm, be they in the engineering sector or in other particular sector. Now, as we all know, for professional services firm, one of the major upside to them is the customer relationship that they hold with their customers, which may be translated in their order book, as in, are there any continuity of orders from these particular customers itself? So I would of course suggest that we approach it from the perspective of the income approach, where you look at what is the company's order book, because certain customers, there will be repeating business from this particular customer moving forward. And of course, if this firm has been around for a long period of time, there are sufficient data for you to support their ability to hold on to this particular customer. So always look at it from the perspective of the company's order book, which will also be able to support what is the growth trend they are looking at, because most often than not, you have your ready customers today, you should not discount that company of their that firm of their ability to grow their customer base in future, which you can also see from their historical growth. Now, some of you would also ask is that, hey, professional services firm wouldn't most important value lies in their human asset. True, the human assets are very important because the human assets are the one that run that firm. The firm itself has no brain, no hands, no legs to actually churn out the value from the order book. But bear in mind, you do not have control over your human capital. You cannot control your human capital's movement, notwithstanding that you may have employment contract in place that lay out the terms and conditions of employment, but you cannot stop your human capital turnaround. And if you look at it inversely on the flip side itself, your human capital, the value that you get from your human capital are more or less translated in the realization of the order book you have on hand. So always think from this particular perspective. That is my suggestion to you. One of you also asked that if you're valuing an airlines or a tourism business, how do you adjust your future earnings, especially in light of this pandemic? Now, as we all know, one of the main challenges that we face when we value such business today is what is the certainty that they will be able to bounce back in future to reach where they were before this pandemic kicks in. So I would suggest that you moderate your future earnings over the short-term period itself, because of course we have travel bubbles in place, and of course demand has been really outstanding because a lot of us were really tired of being locked down all this while. People are actually looking forth to go out, and also we have reached very high vaccination rate, which actually enables it to happen. Now bear in mind also that these travel bubbles, whether domestically or even happening overseas, they have only just started. We do not have any certainty how they will perform in future. Maybe it will really work, maybe it will really drive the growth of this industry back in future, which we cannot tell right now. So if you're estimating your future earnings based on what the scenario is happening right now, or even the airline operators are being pretty optimistic of this based on the reception that they have from the public, always on the side of moderation. Moderate your earnings that you wish to achieve or you can achieve over the short term. How much sales do you think you are able to provide or to able to generate over the short term itself as compared to what you were able to generate before the pandemic kicks in? Now, I have a question over here that if you have a business in a matured industry, how do you actually determine the growth rate? Again, I will limit my answer to refer to the year-on-year growth rate as to what you would usually apply in your consideration when you're evaluating your business, and also a bit technical, what we call a terminal growth rate when we are using the income approach to value this particular business. Now, if you talk about a year-on-year growth rate, as the name suggests, it's a matured industry, there will be sufficient market data available for you to take and apply it in your assessment. When it comes to the terminal growth rate, in a way, this is a growth rate that you expect that particular business to perform year on year in perpetuity after the period where you forecasted it. So in this case itself, this perpetuity growth rate, I would say that you cannot actually match it to what the industry growth rate is, because you may be limited either in terms of capacity or in terms of how your products pricing or services have been performing historically. Let me just share with you an example of what we did. We had recently concluded a valuation of an education service provider. So when we were considering the terminal growth rate of this particular business itself, what we noticed is that, or what we found out, there is no plan for that provider. That provider has no plan to expand the capacity of what they already have today. But historically, what we noticed is that fees were on an increasing trend historically as per norm in this particular industry. So when it comes to assessing the terminal growth rate, we cannot discount the fact that that proprietor will be able to increase their earnings in future, in perpetuity, from the increase in fees rather than the increase in capacity. But then again, the fee increase also, you've got to moderate it because you're looking at what one will grow every single year in perpetuity, assuming that it will go on over an indefinite period of time. Now, another question that I have is that what would we consider when it comes to valuing a loss-making business? Now, similar to the case study that I've just shared, Gojek's business in Thailand is loss-making. So what actually drives its value is what are the growth drivers. So the same thing if you're looking at any types of businesses which had not been able to generate operating profit all this while, check whether or not do they have a robust turnaround plan. In that turnaround plan, what actually drives it? Is it some potential order book that they will be able or close to getting, or even like in Gojek Thailand's proposition, whether or not do they have a robust enough data or information to support their growth plan in future. Now, if this company does not have any robust plan in place, or it is pretty difficult to estimate whether or not will they be able to achieve any profit forecast in future, I would suggest that you value that company from the cost approach perspective, that is looking at what the company has in its books at that point in time, what are the assets and liabilities they have, and come up and estimate what is their adjusted net asset value, or even if they own any intangible asset which may be of value to that company. As said, the cost approach is actually a pretty, I would say, is the most basic approach that you can consider, especially when it comes to evaluating a loss-making company. Now, one question that I have also is that how do we treat undeclared or contingent liabilities? I would say that you have to consider it before you conclude the fair market value of that particular share you're valuing. And contingent or undeclared liabilities, they actually reduce market value. So in a way, one would ask, hey, why do I need to consider this? But bear in mind, any new owner that steps into the business, they would have to assume this particular risk should this liability crystallize. So when we are valuing any businesses or companies with undeclared or contingent liabilities, you'll have to assess what is the potential that such liability will crystallize so as to adjust it in your fair value before you arrive at the final fair market value. So I'm going to stop sharing my slides over here and attend to the questions that come in from the web itself.
Okay, thank you. That was a very riveting and informative session shared by Jessica. So we have some questions here. One question here from TND, right? Everything.
Yeah.
But before we go there, let me try to summarize some of the points, if I got it correct. The method of valuation is basically comprised of two. One is scientific and then art. Scientific is supportable by evidence, and the art is then the adjustments that you need to do to it. So in the question of what I've mentioned earlier about a business owner who builds something and it becomes sentimental, and then there's intangible, so-called intangible assets like reputation, its network and stuff like that. So that falls into art, right? Because you have evidential, and then you try to push up the premium by adding that art part of it, right? That's how you do it.
Well, Sean, when it comes to reputation, right, I would say that it's pretty perceptive. And also when it comes to reputation also, chances are the value of that reputation of that particular establishment, it would have been reflected in that company's cash flows. Let me share with you what I've encountered previously as well. I've looked at the valuation of a healthcare service facility before. So the proprietor, in their view or in their attempt to justify why they should have an additional premium on top of the fair market value due to the reputation they have, because hey, we have been performing or we have been operating over there for more than 10 years itself. There is a certain level of reputation that we have with the area or with the community over there. So when I looked at it further, what I noticed is that number one, over the years when they were in operation, the level of earnings that they have is somehow maintainable at a certain level. That is one. And most importantly, there is still excess capacity within that facility itself. So if you talk about reputation and try to justify a premium on top of the fair market value that is ascribed based on your cash flow, I would say that most often than not, a company's reputation would have been shown in its cash flow, judging from the amount of business that it has historically, which will be able to justify moving forward. So I agree with you in a way, Sean, that is pretty perceptive, but sometimes it may be able to show in the historical performance.
Yeah, but okay, there's some way we can do it. Let's say if the acquirer, if your business is, let's say, reputable for high-end market, for example, and the acquirer is on a medium and lower end market, so they really want to acquire your company based on the reputation, even though you don't show the numbers to support that. Based on your reputation of the high-end market, that's a value to it, right?
Yeah, in that sense, I think if I understand it correctly, the acquirer is looking more at the company's customer relationship, which of course, if it is proven that the company is able to hold on to this relationship or this far, there may be a certain value that is able to attribute to this customer relationship, which I'm afraid is a bit technical if I'm to elaborate it further over here. And there are other questions that I think our participants have asked over that.
So it's on the chat box. Do you have anything?
Yes, sure. Yeah. Yes. Okay, I have this question from Ting Tian Hua, actually, who asked, how do we adjust companies affected by government policies or quota, such as if a company has a quota of 30% Bumiputra equity against a normal company? Now, you see, when it comes to valuing a company's equity itself, usually the way we look at is what is the company's worth on 100% equity. The quota for Bumiputra equity or even the owners for that company itself, I would say that up to now, I have not encountered any particular case where I would need to adjust it specifically. Because even if any particular owners going into that company, you're actually investing in that company based on its worth, whether or not does that owner falls within a certain requirement as set by government policy, or that owner is just another potential investor that wish to invest in the company. So where I'm coming at is that any particular investor in that company is actually riding on what the company is able to earn for them. So I have not encountered specific cases where we have to make specific adjustment to fulfill a certain block of shares due to
I think, Jessica, this got to do with just this recent case of the logistics company. Okay. The government is forcing existing to be able to operate to offer up shares. So in a way, it is forcing you to have a fire sale. So the valuation will have to be adjusted in that way because you're forced to sell.
If you talk about a forced sale, okay, may I understand more that logistics company, right? When the one that
they say that in order for you to be able to think, you have to give up 51% of your company to a Bumiputra concern.
I think I heard someone mention this the other day that is very hot in Facebook right now under this. Yeah. So you see, in cases like this also, if you are the company's proprietor, okay, and you have to adhere by this policy right now, what is the value that you need to place to your shares in order to get that 50% block bought out? Are you willing to actually sell it below fair market value, or do you wish to dispose it at fair market value, which is of course most proprietors would wish to consider in such a manner? So in this case itself, I would still say if I am to do the valuation of this particular share, I would still suggest it at fair value, because you know why? That investor who bought into that share, that particular block of shares will need to be fair valued in the proprietor's books at the other end itself due to financial reporting requirement. Now, this is only from the fair market valuation perspective. Of course, as we know, on the negotiation table, anything can happen at the end of the day. It's just like us selling our properties. If we can't get a buyer, we are desperate to sell it, you're willing to consider below market value. But that is your assessment. That is your call as a business owner. So we should not be we should not be, what do I say? We should not overlap fair market value as compared to transaction value, because transaction value, which is of course, it could be either higher than the fair market value or lower as due to suit the circumstances.
All right, thanks.
Yep.
There's one here from TNB, Anwar. It says that it's a privately owned company. That's very difficult to get data and information, right? Maybe you could suggest some reliable sources for you to be doing that. I guess it's part of your Crowe's expertise. You're going to do a bit of detective work, right?
Yeah, we got to do a bit of a detective work online. Okay, in this case, what we do is that usually we will rely on certain sources. Some of us will use Capital IQ, some of us use Bloomberg, like what we apply here in Crowe, to look for comparable sources. And like what I've mentioned earlier on, if you're especially when you're valuing a private limited company, because the sources that we use, the peer data that we usually base on will generally be public listed companies. Why do we keep stressing on public listed companies? Because only public listed companies have share price for you to base it against. The private limited company has no share price, and data on public listed companies are the ones available. So if you're relying on such data, of course you have to adjust it for the lack of liquidity or marketability of your private limited company shares as compared to the public listed companies, which are more liquid because it is easily traded in the market. You have to also adjust your data to account for other factors, especially if you're buying a minority interest, do you actually have control or not, and vice versa. So in a way, if you are trying to get, that's why I said there is the main challenge that we face in getting a pool of homogeneous data, as in, I would of course prefer it if I have a pool of homogeneous data coming from private limited companies that can just apply it directly to my valuation, because I'm actually compared apple to apple, but often than not, this would not be the case in the valuation. Now, Sean, since we are talking about the source of information, we are talking about detective work and all that, I have this other question from Ting Tian Hua, who asks, is beta the same? If not, how is it adjusted? Ting, I believe you are asking about the beta that we use when it comes to calculating the discount rate. Now, you see, the beta, apologies everyone, this is a bit technical, but since Ting asked this question, I think I should just address it as short as I could and as straightforward as I could. A beta it actually shows how that particular company is performing in that particular market itself. So when you are relying on beta, on public listed companies' beta for your valuation, usually what we will do is that what we call unlever, which is we remove the company's capital structure element from this beta, and then before we relever it, or what we call, we multiply it back against the target company's capital structure to make it more relatable to the target company. So I hope I answer your question, Ting, but if you see there are more interest regarding this particular topic, which is very technical, and I don't wish everyone to lose their lunch appetite since it's lunch hour right now, I would rather not talk much on it, all right? Now, I have this other question by Chan, C. Keong Chan, who asked, what is the reasonable risk premium for a country like Malaysia, given her country risk currently? Now, you see, when we apply a risk premium to a particular locality, if you're valuing a target that is a Malaysian company, of course you apply Malaysian risk premium, especially if the target's business is only domiciled in Malaysia. So when we are trying to, how we get the data relating to the risk premium itself, it will be more relating to the source. So usually what we'll do is that we'll check our Bloomberg source, we check Damodaran sources to see what is the risk premium ascribed for a country, because the way the risk premium is calculated from that particular source itself, it is either benchmarked against the risk premium of a mature market such as US, or even what is the rating for that particular country. So again, a bit technical on the background, but usually what we'll do is that we just rely on the market source for risk premium of that particular country, right? Now, I have a question. Oh, I think, Sean, you have presented this question by Anwar Hussain regarding private limited companies, so I shan't touch on it again. Now, I have this question by O. Tek King, as in, how do you value a seller's claim for goodwill, basically to reduce it? Now, this is usually very cliche amongst a lot of business owners. After they concluded their acquisition, the main thing is your goodwill, whether or not how much goodwill that you need to absorb in the book. You see, okay, I'll try to make it less technical in this sense, since I've already touched on purchase price allocation exercise in my concluding remark. You see, when you finish acquiring a company, you acquire a company with assets and liabilities and also intangible. So you will of course do a fair valuation on this pool of net tangible assets, as well as the intangible asset for you to allocate your purchase price across. And whatever it is that you cannot allocate, that would suffice as your goodwill. And as I mentioned earlier, your transaction value may not reflect your fair market value. It could either be higher, certain companies will pay more premium due to the synergistic benefit, or it could be lower. So in cases where it is lower, of course, you have what we call a bargain purchase, good and bad in that. And when it's higher, of course, which cannot be substantiated by the fair value of the target's assets and also intangible assets, you will of course have a goodwill. So how do you value a goodwill? The goodwill is more like a balancing number. So basically, you value that company's tangible assets and tangible liabilities first, and followed by any intangible assets that fulfills the requirement to be treated as one and to be valued separately. And thereafter, what it is that cannot be substantiated by this fair value of this pool of net assets, that will be the goodwill. It is actually the balancing number. You don't ascribe a value to it. So in short, to be rational, always think from a valuation perspective before you arrive at your transaction value. That actually saves a lot of heartache, I think. All right?
Now, I guess the goodwill is where the story is, right? How compelling the story is, isn't it?
Exactly. Yeah, but also you will need to manage it because you know your books best. As the acquirer, you know your books best. So if you have this particular amount of goodwill that is sitting in your book, which you'll need to test for impairment each year after that, whether or not there's the carrying value moving forward, is it enough for you to support it so that you need not impair that goodwill, which if that happens, that would affect your profit line in that particular year itself. So a lot of maneuver is involved, a lot of management is involved, and I must say there are a lot of heartache involved, especially when we really cannot reduce that goodwill lower than what they wish to expect it. So,
yeah, especially when you're talking about family-owned and it was the brothers or the cousins, trying to dissect the empire, that's where the goodwill and things come into picture. It is very emotional, right? Yeah. Okay, so there's one last question there, right, by Anwar Hussein from TNB.
I have this question on the privately owned by Anwar Hussein, which you already stated to everyone.
Oh, there's another one, which is the WECA.
It's sorry, because I'm actually scrolling down as I read it over here. I'm not sure whether am I reading the same page as you do, Sean, but I'll come to that when I see that. Yeah. Okay.
Right at the bottom. I think that's the last.
I know. Let me just attend to Christina's question first, which comes after O's question. Yeah. So as in, how do you value the goodwill of the company and the customer relationship? I think I have already explained it earlier on, Christina, that the goodwill is actually the balancing number after you've valued all particular assets and liabilities. But as far as the customer relationship is concerned, usually the method that we use is to use the income approach to value it. Of course, you have to fulfill certain requirements to deem that this customer relationship is measurable, especially in terms of control. Now, how do you determine control? Control can either be determined if you have entered into the contract with that customer, or also it is seen from the perspective of whether can you control any earnings coming forth from this customer. So in this aspect, it will come over to the implicit assessment side, or even the factual side itself. Factual would be historically, how much have you earned from this customer? How long have you been able to hold on to this customer? And on the implicit assessment side, what do you think that this customer will stay with you in future? So that is more on the implicit assessment side. And Sean, if you're looking at family businesses, usually this is what we usually call the renching, the gamching inside the family business itself, that they perceive they'll be able to hold on to it and so forth. Yeah. Okay, Anwar, come to your question now. Using the income method, is WACC good enough being the hurdle rate as you've read? Some using VARA based on my experience. What is my preferred basis and more rational? You see, Anwar, when you use the income method, You see, when it comes to the discount rate, some would also say that it depends on what is the cash flows you are using as the basis for your income method. If you use what we call the free cash flow to firm to value business value, of course you would use the WACC, which is in a way the weighted average cost of capital. WACC, in short, it shows the return to both your business owner, which is your shareholders, and also the debt owners, if you are valuing a business value. Now, if you're using a set of cash flow that is net of financing or net of borrowings, repayment itself, then of course the discount rate, you cannot apply the discount rate because the cost of borrowing is already net off from the cash flow. So in a way, you may want to consider using a cost of equity, which is basically the element of return to a business owner that is available that you should assess for that particular owner itself. All right. So now I think, Sean, I've actually concluded all the questions over here. I don't see any questions coming in. Yeah.
Okay, so I think it's we are past the 1:30, so we are one hour. So I guess we can conclude now. Very informative. Quite good in answering a lot of the stuff. That's so a balance between the storyline and what is evidential. Okay, so that's where the balancing of it is. And I guess Crowe Advisory itself is able to assist you in either on the seller side in valuation or on the buyer side where you can then challenge the valuation that the buyer is throwing it out for you. So, okay, that's some of the things that your advisory will be able to do so. So without further ado, I thank everyone for attending and all the questions. And if you should have any further questions that you want to do so, just get in touch with us, and then we'll pass it through to Crowe, right? Any last words, Jessica?
Well, I just like to thank everyone for your patience, for putting forth your lunch hour. I hope that it is not too boring for you or too dry for some, actually. So if you all have any questions, feel free to reach out to us at Crowe Advisory. We'll be more than happy to address your queries. And also, I'd like to extend a thanks to MICCI, to you, Sean, as well, in accommodating us today for this particular session. Thank you so much for this opportunity.
Okay, everyone else, just keep your eye out. We are on Facebook, we are on Instagram, and most of the social media platform. There will be more coming through. So keep an eye out. There are things that's going to be discussed other than this. So until next time, was it lunchtime already? Happy lunchtime, and see you guys later. Bye.